4 times a year, after the quarter closed, someone at WorldCom opened the general ledger and typed a single journal entry, round numbers, hundreds of millions of dollars, and no supporting documentation whatsoever. With that one entry, the company's largest expense quietly left the income statement and reappeared on the balance sheet as an asset, and a business that was losing money reported a profit. It was the crudest major fraud in the history of American markets, and it worked for 5 straight quarters. By the government's final count, roughly $11 billion of earnings were fabricated this way, and on July 21, 2002, the company collapsed into what was then the largest bankruptcy in United States history, roughly double the size of Enron, which had fallen just 7 months earlier. Equity that had been worth somewhere near $180 billion at the peak went, in the end, to zero, and 17,000 of 85,000 employees lost their jobs in a single announcement. This is the autopsy of WorldCom. Bernie Ebbers was a former milkman, bouncer, and motel chain owner who co-founded a small Mississippi long-distance reseller in 1983. Over the next 15 years, he rolled it up through more than 60 acquisitions, paying with WorldCom's own rising stock. And in 1997, he won MCI, a company roughly 3 times WorldCom's size, with a bid of about $37 billion. It was, at the time, the largest merger in American history. By June of 1999, the stock peaked at roughly $64.50, and the market valued the company somewhere near $180 billion. Understand the machine before you watch it break. The stock was the acquisition currency, and every deal reset the accounting, fresh write-offs, fresh reserves, a fresh growth narrative for the next quarter. Growth by acquisition masked weak organic economics, which means the machine only worked while it was buying. In October 1999, WorldCom announced a merger with Sprint valued at well over $100 billion, the largest ever proposed, and in July 2000, American and European regulators killed it. Mark that date, because it is the structural break in this story. The roll-up machine could no longer buy growth. At the precise moment the dot-com bust turned telecom into a glut of overbuilt fiber and collapsing prices. The deals were over, but the guidance was not. Now the mechanism, because the mechanism is the story. WorldCom's single largest expense was line costs, fees paid to other carriers to lease network capacity to complete its customers' calls. And in 2001 alone, it expensed roughly $14.7 billion of them. The accounting rules are unambiguous here. Recurring fees to carry today's traffic are operating expenses, recognized as incurred, and most of WorldCom's were fixed, locked into long-term leases signed during the boom. Chief Financial Officer Scott Sullivan had trained Wall Street to grade WorldCom on a single ratio, line costs at 42% of revenue. After the bust, actual line costs were running above 50% of revenue, and internal staff described the 42% target, in their own words, as wildly optimistic, pure fantasy, and impossible. Sullivan reported 42 anyway, every quarter on the line, manufactured by whatever plug was needed. Phase 1 of the plug, 1999 through 2000, drained the reserves. Accruals set aside for expected bills and merger costs were released against line cost expense to hit the target, roughly $3.3 billion of what accountants call cookie jar accounting. But a reserve is real money exactly once and reusable never, and by late 2000 the jar was empty. Phase 2 was the escalation, and it is the reason this episode exists. Beginning in early 2001, Sullivan's shop, Controller David Myers and accountants Buford Yates, Betty Vinson and Troy Norman booked quarterly topside entries that credited line cost expense and debited capital asset accounts, under an invented label, Prepaid Capacity. An ordinary operating expense became a long-lived asset. Rent, in effect, became property. Trace what every moved dollar did, because it did three things at once. It cut reported expense one for one, instant, fake, pre-tax profit. It created a fictitious asset to be depreciated over years instead of expensed now, pushing the lie into the future at a slower burn rate. And it inflated reported capital spending, which analysts read as confident network investment, a red flag repainted green. The scale, $3.055 billion moved in 2001, and another $797 million in the first quarter of 2002, $3.852 billion in total. Strip those entries out, and WorldCom's reported first-quarter profit of $130 million becomes a loss of $395 million. In every period it claimed to be profitable, WorldCom was losing money. Meanwhile, at the top of the house, a purer piece of market plumbing was failing. Ebbers had pledged enormous blocks of WorldCom stock as collateral for personal bank loans funding a cattle ranch, timberland, and a yacht builder. And as the stock fell, the margin calls arrived. Rather than let him sell, a signal the board feared more than the debt itself, the board became his margin lender, ultimately consolidating everything into a single promissory note of $408.2 million. Read that structurally. The board converted its chief executive's personal margin risk into shareholder liability, and its own later investigation called the loans a 19-month sequence of terrible decisions. Ebbers was forced out on April 30, 2002. Salomon Star Telecom analyst, Jack Grubman, whose firm had collected roughly $115 million in WorldCom banking fees, had cut his buy rating only 8 days earlier, with the stock already down more than 90% from its peak. Now watch the credit stack, because credit, not the tape, sequenced the death. In May 2001, WorldCom had sold nearly $12 billion of bonds, then the largest corporate offering in American history, on financial statements that were already fraudulent. In May 2002, Moody's cut the company 3 notches to junk, ratings triggers hit its receivables facility, and management defensively drew the entire $2.65 billion revolver. The fraud's real product was a fake low-variance earnings stream that sustained an investment-grade rating and cheap unsecured funding. WorldCom did not die of losses, it died of access. The fraud was not found by the SEC, by a short seller, or by Arthur Andersen, which had signed off on every fraudulent year while, per the board's own investigation, being denied access to the very ledger that held the entries. In late May 2002, WorldCom's Vice President of Internal Audit, Cynthia Cooper, pulled the scheduled capital expenditure audit forward by months, and her small team queried the general ledger at night to avoid tipping off Sullivan's finance staff. Auditor Gene Morse found the first smoking gun, roughly $500 million of computer expenses booked as capital assets, with nothing behind them at all. The trail summed to $3.8 billion across 5 quarters, huge, round, and undocumented. Sullivan asked Cooper to delay the audit by a quarter. She refused, went over his head to the audit committee chairman, and brought in the new outside auditor, KPMG. Sullivan was given a weekend to justify prepaid capacity in writing. His white paper failed, he was fired on June 25th, and after the market closed that day, WorldCom told the world. Here is the detail worth sitting with. The stock closed that same day at 83 cents, down roughly 99% from its peak, before anyone said the word fraud out loud. The market had been pricing distress for 2 years. The announcement merely named it. The SEC, whose inquiry had quietly been open since March, filed civil fraud charges the very next morning, one of the fastest enforcement responses on record. And when trading resumed in July, the stock changed hands for single-digit cents. On July 21, 2002, WorldCom filed for Chapter 11 protection. $107 billion in listed assets against $41 billion in debt, the largest bankruptcy in United States history at the time, a record it held until Lehman Brothers in 2008. One forensic footnote belongs on that headline. The record-setting asset figure was itself partly fiction, book value the fraud had manufactured, and tens of billions of it would later be written off. Even the tombstone was inflated. Congress had let post-Enron reform stall in the Senate. WorldCom unstalled it. Sarbanes-Oxley was signed on July 30, 2002, 5 weeks after the disclosure and 9 days after the bankruptcy, requiring chief executives and chief financial officers to certify their financial statements under criminal penalty. Section 402, the ban on company loans to executives, exists almost line for line because of Ebbers' $408 million note. The tally kept growing after the flames were out. August brought another $3.8 billion of improper items. The board's Special Investigative Committee eventually put the fraud at more than $9 billion, and the Justice Department settled on the round total history remembers: $11 billion. Keep that number separate from the restatement. $74.4 billion of reductions to previously reported results, most of it the acquisition machine's goodwill finally marked to reality. $11 billion was the lie, the rest was the machine's true worth. Ebbers was convicted in March 2005 on all 9 counts, largely on Sullivan's testimony, because no document ever tied him to the entries, and sentenced to 25 years. Then the longest sentence ever handed to the chief executive of a major American company. Sullivan, the architect who cooperated, got 5 years. Betty Vinson, the accountant who protested, tried to resign and kept booking the entries anyway, served 5 months. Cynthia Cooper was named a Time Person of the Year, and later said the aftermath felt nothing like a victory. The money came back in fractions. Shareholders recovered nothing, bondholders roughly 36 cents on the dollar. The class action clawed back about $6.1 billion, over $2.5 billion from Citigroup, $2 billion from J.P. Morgan, and in a landmark almost never repeated, roughly $25 million out of 12 former directors' own pockets. WorldCom's own employees watched the company stock inside their retirement plans fall from over $640 million to under $19 million. The network itself survived the corpse. The company emerged from bankruptcy in 2004 as MCI, and Verizon bought it in 2006 for roughly $8.5 billion, assets that had once carried a 12-figure valuation, acquired for cents on the peak dollar. Ebbers served 13 years, was released on compassionate grounds in December 2019, and died 5 weeks later, at 78. So commit to the thesis. WorldCom did not die of fraud, it died of arithmetic. The sprint block ended the acquisition treadmill. The cost structure could no longer support the 42% story, and Sullivan's journal entries were intravenous drips keeping a corpse warm, while 30+ buy ratings, a Big 5 auditor, and an open federal inquiry all missed it. One internal auditor found it in weeks, at night, with a query against the company's own ledger. Because the most dangerous number in any financial statement is the one that never moves.